You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Well, you know how risky it is trading, especially now, investing, buy and hold and go down with the ship. Well, there's got to be a better way. A person you're about to hear from believes he has found it. His name is Roger Khoury. For over 10 years, he's had Market Forecasting Academy, marketforecastingacademy.com, but he's been trading back since the 90s, which makes him a seasoned veteran on Wall Street. Since most of you Wall Streeters really, it was just a couple of years ago, you were in diapers. You haven't lived through a bear market, a really fearsome bear market, the kind of thing that nightmares are made of. Roger, it's great to have you on the show. So sum up, how do you make a small fortune on Wall Street? And don't tell me you start with a large one. How do you do it?
So it's actually, the key is to be consistent, right? Because consistency is what grows an account. It's what allows it to compound into meaningful outcomes. And you can't have consistency unless you know the very basics of how to understand what drives the market. So what causes prices to rise and fall? At the end of the day, it's essentially demand. As demand grows and expands, prices will rise. As demand shrinks or contracts, prices will fall. So what I decided about 10 years ago, after having been in the market for 14 years and constantly chasing the next new thing, version 2.0, what's working now.
New thing.
It was crazy, you know. I had to there's got to be some way to be consistent, right? Not the start and stop. Well, it turns out I had to throw everything out, and I had to approach the market completely differently. And I decided, it was through a bunch of serendipitous events, but I decided I'm going to look at what causes the market to move. And I found out there's actually 8 major forces of supply and demand that are affecting prices. Most people, including professionals, are taking into account 1, 2, maybe 3 of those 8 factors. So primarily we're looking at fundamentals, technical analysis, maybe some news and, geopolitical events, right? But that's about it, right? Maybe a combination of those. Well, there's another, 4, you've got 5 more factors there. So besides fundamentals, besides geopolitical forces, besides the news, you've got volatility and its different phase shifts. You've got market sentiment. You've got liquidity levels, which includes volume, order flow, trade flow. You have what I call prime liquidity pools. Now, anyone who has any experience in the market will recognize how the market's often manipulated, and they feel like they're being personally sought after by the broker or market maker, where they go in and they hunt their stops, right? Well, those are areas where the market can be manipulated, but the market can't be manipulated beyond a certain level. And if you think about a rubber band can only stretch out so far before it snaps. Now, the market's not going to snap, but what you do is you find that the market has to, if it snaps back to where the actual demand is. And if you look at one side of this rubber band, we can call that demand, and this other side of the rubber band can be price. So price is always a lagging indicator to where the demand is. So demand is essentially a leading indicator to price. So if we can identify where demand is in real time, we're going to know with pretty great accuracy what price is likely going to do next within this margin of where it can bounce around here, right? So that's where the market can be manipulated. And so we have to take those into account. We have to take into account those imbalances. And of course, you obviously have to take into account the technical analysis and all of their little subsets. So when you look at that together, suddenly you have a snapshot of real-time demand. And the way you make money is by focusing not on, well, demand is here and price is here. Well, that's not an investable opportunity. Sure, can price come back and catch up with where demand is? Yes, it always has to. However, there's this margin where it can kind of play around and even stretch further away from demand. So we have to have the wisdom to understand, just because the market's forecastable with great accuracy, it doesn't mean it's investable or tradable. So what we need to do is look for where there's significant imbalances between price and demand. And where you see a significant imbalance, now you know that the likelihood of price to travel further away from demand is low to unlikely. That creates a very low risk, high probability opportunity for profit. You see the trick there? And if once you know you've got that level of accuracy, we're talking about no less than 80 to 90%, now you know that you have a very consistent, confident, objectively clear experience that's going to enable you to come to the market and build your account with sustainable consistency.
All right. So that's what we want to hear. Just one question. Now, I know relative strength is generally considered a technical aspect.
Yes.
Kind of overlaps on several of those other factors you're talking about.
So it's interesting. So relative strength is an indicator that's derived usually from price, right? And so if we know that price itself is a lagging indicator, and this relative strength indicator is a derivative, it's derived from price, it makes it even further lagging, right? So we're always constantly using these lagging indicators in the market, which is where people tend to focus on, and they try to find these smart, savvy, really intelligent ways to try to create strategies that can take advantage of a relative strength or a momentum indicator or some oscillator. And that's great, but there are times and seasons where those will work, but then there are times and seasons where those are going to be not as effective, right? Where the market conditions change just enough, as they always do, and then it's not as favorable to those types of approaches. So you're back to the drawing board looking for the next indicator that might work. Maybe it's momentum this time. Maybe next time it's not momentum. Maybe the market's going sideways and chopping, so you can't use momentum there. So all these things really are lagging indicators that we really want to stay away from and look instead at what is demand telling us so we have a better understanding of what we can expect price to do next.
All right. So obviously, to measure those factors, those 8 factors you mentioned, you got to be able to find the data. Where do you get this data? Is it just opening up the Wall Street Journal and looking at 5 numbers, or is it more complex than that?
It is unfortunately a little more complex, and it was so complex that I was getting bug-eyed doing everything, and I had a season in which I went through and began to see if I can find ways that I can correlate certain aspects. At one point I had 4 monitors, and I had a dozen or more indicators on my charts. Plus, part of these indicators weren't just price derived indicators, but rather, do you remember many years back when they started to be able to track real-time news releases, where we had scheduled news releases? And you have these indicators that could kind of in real time quickly give you how that's likely to impact the market. So we have all this data now available to us on the internet. Mm-hmm. So I started pulling that information and began to correlate those and combine them into one smooth indication that kind of is like a calculator that tells me kind of what's going to fuel the market. It's an aggregate visual indication of all of those combined demand factors. So think about when you get in your car and you want to take a long distance drive. Let's say you and I decide we want to we want to go 250-mile road trip. Well, if you and I get in your car and we see that you have a quarter of a tank of gas, we know instantly from that visual indication, without looking in the engine or reading the owner's manual, we're not doing anything complex. We can see that we have a fuel gauge that says a quarter of a tank of gas we know will not take us 250 miles down for our road trip. It tells us you need to stop and get gas. So that's great, because what that does is it tells you what you should be doing next, right? And so what I've done is I've had to take all of those data points that are available through the internet and pull those together. So it gives me that fuel gauge. Then the real key is not the indicator itself, lest anyone think this is technology based, because that's really also kind of a lagging aspect, because technology is kind of limited. And we'll talk about that in a second if you'd like to. But what we want to do is now apply a process of how do we interpret this and how do we look at everything holistically, so we have a kind of a 360-degree view of the market that gives us the level of accuracy. So the process of analysis is critically important. Does that make sense? How do we interpret that data?
All right. So your system, how far can it look down the road? Is it daily, weekly, monthly, yearly, decades? Obviously, to actually make money, it's got to be a relatively shorter term, but how does it work for the longer term?
That's such a brilliant question. Kerry, if you think about when we forecast weather, we see that we've got poor or bad weather oncoming, right? Think of how accurate our forecasts are when they're a week or 2 weeks away versus how accurate the forecast is when it's just 24 hours away, right? The closer in time, the more accurate it is, right?
Yeah, or
Now,
when you look out your window, when the weatherman looks out the window, he's generally the most accurate.
that's right.
Actually happening, but that's kind of useless then.
That's right.
What's happening? It's already too late. I wanted to know that, yesterday I should have put my umbrella in my car.
That's exactly right.
That's
exactly right.
That a lot.
So to basically go beyond that, what the methodology strength is at is basically you can forecast depending on the condition as much as a few months away, but then you can also see that there are conditions that says you're not really going to have a very accurate forecast if you go a few months away. You're going to have to be looking at on a 1 to 2 or 3 day basis in terms of long term. That's about, and right now we're in a market right now where the analysis model is telling us we can't really depend on much more than a 1 to 2 or 3 day out level of accuracy. But then as you go shorter term, here's what's interesting. As you go shorter term, let's say if you want to spend a very efficient, very effective, 1.5 to 2 hours in the morning or in the evening, in that 2 hour block, because the market is cycling up and down that whole time, those inefficiencies where the market between price and demand, if you go back to that rubber band analogy, those will occur throughout the week multiple times, week after week. And so you can very effectively go in, and though on the surface it looks like, well, we're just kind of trading, or maybe it looks like we're day trading. We're not at all, because what we're doing is investing in these short cycles where you're seeing where there's an imbalance between demand and price that makes a opportune time for us to see a low risk, high probability profit opportunity. What I call that is demand imbalance arbitrage. We're literally arbitraging or taking advantage of the difference, those short-term cycles where price is so out of whack with where demand is, it has to snap back to catch up with demand. And that gives us a very accurate, very confident profit opportunity. So we don't have to wait long-term to make our profits. And that's what allows us to compound our capital more frequently. Does that make sense?
Yeah. So give us some present day examples, recent trading successes you've had as a result of your system.
So really, the trading successes really can come and go with week to week. There are weeks where you have 2 or 3 or 4 opportunities during the week. If you spend let's say you spend 10 hours a week, you're going to have anywhere from 2 to 4 opportunities that are available. Now think about what that means. 2 to 4 opportunities in a 10-hour week commitment, whether you do it in the morning, in the evenings, it doesn't matter. That means you're spending most of your time saying no. You're going to see opportunity. You're going to be able to forecast the market. You just are going to qualify and say, that's not investable. That's not a tradable opportunity. And you keep saying no. But you know why you're saying no. It's an objective, clear analysis model. So what happens is when you have an opportunity that shows up, you can see it's as clear as when you grab a piece of fruit at the end of a branch, you can feel and go, wow, that's really ripe. Right? And it kind of almost falls into your hand, right? Versus when you got to really pull and tug and, work the branch to pull the fruit off, that needs a little more time to ripen, right? So in the market, we have similar opportunities where we can kind of tell very clearly, very obviously that that's ripened. And those are the ones we go after most. Now, there are weeks where you can go for 1 or 2 weeks and you're just saying no, left and right. And you have to be okay with that because there's a wisdom to this. We're not looking for opportunities to make money in the market. We're actually looking for opportunities that are not likely to lose money in the market. And that changes everything when it comes to your market experience. So you're not stressed along the way to earning your returns. Does that make sense? So in terms of your successes, it's not going to be something where you're meeting some kind of daily goal. I want to take a position a day. I want to make so much a week. It's not like that. But what's interesting is if you let go of your financial goals and instead focus on the process, my clients for the last 10 years have consistently witnessed that if they just focus on the process of analysis, it more than delivers the kinds of goals that they're hoping for before they meet me. So in fact, it usually surpasses their expectations. Isn't that interesting? So if you kind of get away from focusing on the financial goals, you end up making more by focusing on the process. Why? Because the process is what delivers the results. Make sense?
Yeah. So recent successes, just to share with us some winning trades you've had recently?
Sure. Reasons, one thing I like to always share is client experiences, because if I talk about myself, well, I'm the guy who developed it. Well, sure, you can make it because it's in your head, you've created it. But can you have others replicate that? So I like to talk about client successes. I had a client recently who I just did a trade review with them where they showed me their trade log for the last couple of weeks. Mm-hmm. And they were able to grow their account by double digits with a 90+% accuracy. So that means their decisions were right 90% of the time, and they made double-digit returns in this past month. Does that make sense?
Yeah, sure. So how'd they do it? Like, what were they playing? What trades were they making to achieve these results here, Roger?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
So they were focused primarily on the futures market. And in the futures market, it's tax advantaged, so it's ideal. You can do this on stocks or currencies or crypto or anything. But with the futures market, the first 60% of your profits are taxed at a flat rate of 15%. So that people like that. And so with that approach, what they did was they focused on the futures market and were able to focus on very efficient timeframes, like the 1 minute, 5 minute charts. And they were able to see those cycles when they were really stretched out and there was a significant imbalance between where price and demand. They were able to go in and very effectively profit from those discrepancies as the market had to catch up with where demand was. And then so that's very efficient in and out, usually within a half an hour. So if you think about that, if you spend 2 hours a day, 5 days a week, that's a 10-hour-a-week commitment. Out of that time, you're probably going to get 1 or 2, maybe up to 4 opportunities during the week. It's not very busy, it's not very active, and you're not sitting there glued to your screen, by the way, just watching the prices go up and down. Remember, we're forecasting. That means we're anticipating 1 to 2 cycles ahead of what the market's going to do. So you can look at the market, then you can go read a book, look at an email, do something real quick, come back, glance to see where things are at, because you're forecasting, you're anticipating what is likely to happen next, because you see where demand is going and you know what you're expecting from price. And we don't see price really moving in a way that is creating an opportunity where it's moving further and further away from demand. Then there's nothing there to get interested and excited about where then you want to sit and really focus. So in that 2-hour block, over a 10-week or over a 10-hour period over the week, you're going to find those opportunities where you see, oh, here's a place where the market's starting to fly away from demand, and it's not likely to go much further. And usually it's a very short distance where when you get in, within a few minutes to half an hour, the market catches back up where demand is, and then that opportunity is gone. So you go in very quickly and make a 2, 3, or 4% profit, and you're out. And that's when you compound that 2, 3, 4, 5, 6 times in a month, you very quickly can see those returns compound very quickly. And you're always in control of 2 things, actually. Your experience, so you're not stressed along the way, and your performance outcomes, because you're accurately and objectively forecasting what you can expect before it occurs, and only taking advantage of those low risk, high probability profit opportunities. You're not going into those ones where they're aggressive and you're 50-50, right? That's more stressful.
Okay. So, do I have to be a trader to do this? Because traders' sensibilities, trader instincts, traders being able to control your emotions. Emotions are your biggest enemy in investing, right?
Correct.
So how do you teach your students here, Roger, to manage or control or suppress even their emotions to not get in the way of their trading profits?
I love that question. So if you think about what drives our emotions and when we hear anything in the trading industry they talk about trading psychology, and you need trade psychology. Those things are relevant and are required when you are approaching the market in the traditional sense, using fundamentals, technical analysis, these strategies and technology and all that stuff. But why is that? Because generally, beyond seeing and identifying an opportunity, once you identify, okay, here's an opportunity based on my strategy, whatever it is I'm using, guess what happens? You don't know before you get into it whether that's going to succeed or fail. You're going to have to get into it and find out after the fact. So you're living in a world of uncertainty. There's a lot of unknowns. That's what drives fear, greed, and your emotions. It's those uncertainties. Well, we solve that and bridge the gap of the uncertainty with information, with knowledge, with data. What is that? It's the real-time demand analysis. And when you have an objective clarity on what you know for a fact has to occur because price is so far away from demand that it has to snap back, you know where price is going to drag, where demand rather is going to drag price around to. This allows you to have a level of certainty, a level of confidence, and that takes away your emotions because you don't have that unknown. Now you do know. And so the way we overcome that is we just don't even deal with it to begin with. We don't have the unknowns. And so the one aspect that I will say is a weakness in the methodology is there's a level of raw power to it. It's kind of like, I've seen grown, successful adults come into this early on when I didn't have the wisdom of experience of teaching this to realize that it takes a certain personality, it takes a certain circumstance for someone to come in here and use this appropriately. Because what would happen is I'd see successful grown adults come in here, and all of a sudden they turn into this like as if they're 16 years old, just got their license, and dad gave them a brand new Lamborghini. Now that combination doesn't usually end well.
That's going to end well. He should have given him a bottle of Jack Daniels too.
That's right. So I realized, wait a second, I got to start setting up an application process to start to ensure that I get to know people on an individual basis. I can truly serve them and not allow people who I think are going to self-destruct come in on my watch and allow them to self-sabotage. So the weakness is this: when people start to see, my God, I have a level of control, I have a level of accuracy, I have confidence, that can get them a little bit into this it can feel a bit like they're intoxicated, right? They get really excited and addicted, and they can just go and become very aggressive, right? So if a 16-year-old is going to drive a Lamborghini aggressively, it's not going to end well. No different with a grown, successful adult who comes in and tries to drive this high performance, analysis model. And so what we do is we look at personality, we look at the circumstances at a healthy situation. We don't want people coming here needing to make money. We want people who just want to enhance their future, want to enhance their situation, where they don't need it, but they want it. And then they're not desperate. They can have a much more mature, sober approach to this, right? Does that make sense? They're less likely to fly off the rail. And so that's what we look for. But we don't really have the unknowns, the uncertainty that drive the emotions. So you don't really have that as an issue.
Okay. So this is kind of a black and white system.
Pretty much.
Like it either says what it says or it doesn't, right?
It literally is one of these things where if you come to me and you said, hey, I want to learn how to fly an airplane, it's a process. You're not going to come and say, well, I'll try this and I hope it works for me. No, you either do it or you don't. It's impossible for you not to have a successful career flying airplanes if you follow the process of how to take off and land based on the process that's been developed. So yeah, my methodology is not one of those things you try and hope. It literally is. It's like building a cabinet. It's a process. It's gonna come out with a range of results that's always going to be positive and profitable as long as you responsibly apply it the way it's taught. Right? And if you want to use one more analogy, it's like driving a car. You learn how to drive a car, right? But it's up to you to drive it the way you're supposed to responsibly. If you want to drive it crazy and aggressively, it won't end well either.
All right. I'm liking what you have to say. What's it going to cost me to join? Assuming you want me.
Well, so interestingly, I don't have kind of just a set one size fits all fee structure. How I set it is based on the person's individual needs. I really like to, and if you look me up, you'll find out I don't have people that come to me and where I fail to deliver what I promise. So I don't have any negative reviews from clients and things like that, because I take my time to get to know the person's needs based on their particular situation. And then I address their needs and how much time they need. So we do that together I don't do any kind of sales things. I don't like that. I educate people and we have a conversation. If it looks like it's a good fit, it makes sense to move forward where it's responsible, then I say, here's what I think you need based on what you've told me. Here's the time it'll take. And what I do is actually, I do something very unique, Kerry. What I do is when I figure out how much time they need, I give them my fee structure based on that amount of time. So that's always unique and personalized to them. And they know that they're being taken care of on a personal, individualized basis. However, what I do is this. I figure out now, based on, let's say, the first 12 months, which is the most crucial, what they need to get out of me. I just want to take care of my overhead and my initial time. So I'm at least on a break-even level on the first 12 months. Because of what this does for people over the past 10 years, I've realized, I mean, it's just mind-blowing what people can do with it. So what I do is say, look, cover what it's going to cost me to impart to you and transfer my knowledge and experience onto you so you can come and succeed right out of the gate. After you've doubled your investment on what it took for me to give that to you, then after that, I like to take a share of the profits to take just 10% up to a cap that we both agree is fair. That basically gives me then my profit and the value that I believe I'm transferring to them. And so they know that along the way, I'm fully invested in them and in their success. We both have the same goal together, right? So it's not like you pay me, thank you, good luck. It's, look, carry your own weight. I shouldn't have to pay you to teach you my own life's work, but carry your weight for the first 12 months. Now, usually people are into a real money account after they've trained and practiced and proven they can apply my methodology correctly within about 60 to 90 days. Some take a little bit longer, depends if they're working on through baggage, which goes back to your question. I've had people, women who have been homemakers. They were high school sweethearts, got married, got children. Now they're grandma, never worked, never went to college, and they've never done anything with investing or trading. And all of a sudden they're coming in and running circles around some of the best people because they have no baggage, no old habits, right? They had zero experience. So whether you have no experience or you're a veteran, it doesn't matter. But they tend to come in faster versus people who are experienced need to kind of work out a couple of, wrinkles in their habits for the first month or two. But basically 2 to 3 months, from that point on, they're able to build their account. So I give them plenty of time for the first year to build that account. And that gives them plenty of time to double their investment on what it took to train. And then after that's made me the best investment they've ever made, which is something I pride myself on. And then I take a share in the performance for a limited time.
That sounds good. Roger, people want to find out more about what you're doing, connect with you on the web. How do you do that?
Well, one of the best ways actually I've got a nice little 5-day kind of educational path where they can really learn deep dive into demand imbalance arbitrage and what drives the success of that, which is my market vulnerability analysis method. And so the best way to go and learn about that and get access to that is through raiseyourfinancialiq.com. Raiseyourfinancialiq.com. And that will give them access to that information. They can deep dive into it, learn as, to their heart's content, learn all they want about it, get proof, client experiences, this thing was created, why it works. They'll deep dive into everything. It pretty much answers 99% of all the questions I've ever been asked in the last 10 years. And at that point, if they'd like to apply to find out if there's a good fit, they can fill out the application form at the end and book an evaluation directly with me, face-to-face, no minions in the middle here. I take personal pride in my life's work and really like to take care of people. I enjoy this. I'm having fun interacting with people and doing this.
Excellent. Hey, how much money you need to start from?
Generally, I think for someone to do this responsibly, especially with the futures market, I really recommend, having at least a $50,000 or higher base of capital that you're going to be able to trade with, and you can move on from there. So you don't want someone who I prefer not come into the market with a little bit of money and you feel like you're going to have to be aggressive and drive this thing hard to kind of make up for a lot of lost time. That usually doesn't go well. I want to avoid that 16-year-old mindset going in Lamborghini up front. Does that make sense?
Yeah, makes a lot of sense. Well, hey, if you got a question for Roger, you can always shoot me an email, kl@kerrylutz.com. Don't forget to go over to the site financialsurvivalnetwork.com Make sure you sign up for the free newsletter. You'll see all the links to Roger's sites there and more info. Roger, been a pleasure. Thanks so much for coming on.
Thanks for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.